This is pretty cool. There's a good amount of you guys out tonight. I think I'll probably start just talking a little bit about myself. You know, I've talked about this on podcasts. I kind of want to give perspective that's outside of that. And this is just a presentation that, I gave this talk down in El Salvador. It's pretty quick. I want to go through this. I think that there's probably a few Twitter threads I can hit on as well. But I guess my goal is Bitcoin is this, Bitcoin's this base layer monetary asset, and there's other technologies that are interacting with it. And right now, there's a ton of technical debate within the community as to how Bitcoin can become not just some type of digital gold online, but it can expand into this global, neutral, apolitical monetary system. And that's going to be a really complex thing. And I think that ultimately, there's a lot of narratives about what Bitcoin can do and how it can become freedom money. But none of that happens without solutions to these technical problems. So that's been something that's attracted my interest over the years, and it's something that I've naturally gravitated towards, and kind of the role that I've been playing within the industry. A lot of these debates are happening at a technical level, and when I got involved, I came from a financial background. So I didn't understand computer science well. I didn't know how to code. I had to teach myself some of those things so that I could understand Bitcoin. And I try to bridge the gap between the technical community and the financial community on some of these topics and address, well, when we're talking about scaling Bitcoin, it's not just technical arguments, it's economic arguments as well. And I try to frame it from that kind of a perspective. But first, a little background on me. I was born and raised in Denver, Colorado. I went to school in Nebraska to study finance from the value investment community in Omaha, Nebraska. And came back here. I was working in corporate restructuring for a few years, and then I moved to a private equity fund where we specialized in buying distressed carve-outs of larger enterprises. If you're a company and you have an underperforming division that you want to get rid of, we specialized in buying those. They don't have a back office. They typically need to be turned around in some form, and the accounting's really nasty because you don't know how much the business is actually worth. So I was doing that for a while, and I was following Bitcoin. Because of my CFA, I wrote off Bitcoin as a speculative investment with no fundamental value for years. And it took me a while to retrain my thinking and understand what it truly was. I think one of the problems was that it was proposed to me as blockchain technology. So I had to say, okay, well, if it's a technology, then how do I value the technology? And if I can't associate a cash flow stream with it, then I can't actually get to a value for it. And that's what my response was. I didn't hate it. I didn't think it was worthless. I just said, I don't know how to value it. How do I invest in something that I don't know how to value? And it wasn't until I came across the idea that, no, Bitcoin is an alternative monetary system. And once I came across that, I got very interested in it. And I was always aware of the problems with central banking and how that would work within our broader financial system, but I was very nihilistic about it. I just presumed that this is the way that it goes. Eventually, this system is going to crash. Some other government with a bigger military is going to take over, and the cycle perpetuates over 75 to 100-year periods. And then I discovered Bitcoin, and I was like, holy crap, this changes everything. This network is growing faster than the internet. It's spread globally. It's one of the largest computing networks in the world, and it can't really be stopped anymore. And once I realized that, I was like, time to jump into this industry. That led me to write the book. I wanted to kind of frame this in a way for people that come from the world that I came from and help them understand it. But it ended up getting adopted by a much wider audience than I would have guessed. And after I wrote the book, I spent a lot of time just reading into different details of, okay, well, what are the other protocols? What is the Lightning Network? What is it that's going to bring Bitcoin to the rest of the world? And through that process, it's kind of led me to this idea of, well, there's these two ends of the spectrum where we've seen how cryptocurrencies have basically taken the model of Bitcoin and they've tried to centralize the infrastructure to compensate for fundamental trade-offs that make Bitcoin secure. And that provides efficiencies that create consumer adoption. And that happened first with Ethereum. But then Solana came along and they said, okay, well, we're going to centralize even more. And that created a lot of consumer adoption. And now we're realizing that there's kind of just this race to the bottom in terms of infrastructure. And it's like, okay, well, why don't we cut to the chase here? And maybe we need to figure out a way for this to work systemically, and that there's fundamental economic trade-offs for scaling that we have to acknowledge. And that's a lot of what I'm going to be getting into today. So I recently wrote this paper back in, when did I write it? November. And I've added a little bit extra stuff here, but it's called Banks Without Bankers. And the idea, look, it's clickbaity. I was writing it with Alan Farrington, and he's like, I think I wanted to call it a cryptography and agency within a financial system, a Bitcoin native financial system. He's like, we can't do that. And I was like, you're right. So then we came up with Banks Without Bankers. So a lot of this is based around the interaction between different protocols, in particular, the Bitcoin protocol, the Lightning Network protocol, and then ecash. And that's kind of the primary focus. It's this emergent protocol that's actually existed for a very long time. When the cypherpunk movement started under David Chaum, he was the first to create the blind signature. And that's ultimately what we use for ecash. And it failed. It was one of kind of the first failures of 40 years of failed attempts to create Bitcoin. And I think what's really interesting is that now that we have a digitally native collateral to be backing and an actual digitally native money, something like ecash could make a lot more sense. And there's a ton of research into this area, and people are starting to expand pretty heavily around this idea, and a lot of developers are interested in it. And it's kind of based on the blind signature. I won't go into too much technical detail. I'm going to focus on the economic side. There's a lot of resources that I'll show you at the end that you can read into on this. But a blind signature is a way for you to effectively, for you to interact with a party, or for them to issue you a proof of verification without either of you knowing who each other are. And that creates a really interesting aspect of privacy. Think about it like owning cash, except for when you're spending that cash, the person you're giving it to actually doesn't even know who you are. So that's what the cypherpunks found very interesting. And there were early versions of the internet where they wanted to have ecash be like a native function within some of these protocols. And so the blind signature kind of provides that. It provides unlinkability, and it allows you to maintain privacy. And it also has a feature of offline payments, to where if I'm sending ecash, I'm effectively sending the signed blind signature issued to me by a mint. And that exists within my phone. It's not like Bitcoin, where you have a private key that might exist within your phone, but there is no ledger anywhere, there is no blockchain. You have ecash that exists within the memory of your phone, and you can send it to somebody else's phone. So that allows for offline interactions. Wish I had a clicker. So, and honestly, I probably don't have to get too much into this, but this is in the paper. And there's kind of this system that was devised, and the Fediment protocol and the Cashew protocol are like the two emerging ecash protocols. And they're interacting with Bitcoin. And the idea is basically, if you have a wallet and it has Bitcoin in it, you can send that Bitcoin to Federation A. And Federation A has this multi-sig address where they control it amongst the Federation with just a group of servers that all has signing power over it. So you're giving up your Bitcoin, you're giving up your custody. And that's a big no-no in our world, right? So bear with me. But they're going to send you back an ecash certificate, and that's going to provide you cash-like privacy benefits. It's going to allow you to send this, it's going to allow you to digitally move that receipt as value, constrained by the latency of the internet. And that's within one federation. So if all of us today were like, okay, we're gonna create a mint, and it's going to be me and Tatum and Zach that are going to control the keys, and you guys trust us with it. You guys can all transact with each other immediately. You don't have to pay on-chain fees. You don't even have to deal with any of the abstractions of the Lightning Network to do that. So that's really powerful in terms of efficiency. And what is that? Going back to that point about crypto, well, that's kind of just optimizing for this race to the bottom in terms of efficiency of infrastructure. And it's like, okay, this is a technology where we can actually make that multi-sig much larger. We can make that multi-sig much larger than the Solana network. It's really just a technology that allows us to standardize infrastructure so that we can optimize it for different functions that we need. Now, that's within our federation. if there was a federation with the space, for example, that we had set up, and there will be, and when we have our federation set up, if we want to send our ecash issued by the mint of BitDevs and we want to send it over to the members of the space in some format in exchange for goods or services, then we use the Lightning Network as the spine that connects these two things. And there's Lightning gateways that will forward on a Lightning payment directly. So that's a big idea. It's like you pay the Lightning Gateway forwards the Lightning payment to another federation, and then that federation can decide if they want to accept the Lightning or if they want to convert it into ecash. And that makes ecash amongst federations fungible. So now we're kind of building out here what looks like a financial system, where we have collateral settlement of the Lightning Network on the back end, and that can be done at more of an institutional level, so we can abstract away all the complex aspects of having channel capacity limitations and having to educate people on every aspect of how the Lightning Network works. And that works for a lot, but it doesn't work for my mother, it doesn't work for a lot of other use cases. And when people talk about how Lightning's not doing well or it's failing, it's really that we're learning how to use this system in a way that financial systems function. So this is a key point that I have another paper that I wrote over a year ago, and this is what first really got me into ecash, was when I was reading into how free banking systems function and how these systems were, the term free banking is associated with fractional reserve because that kind of naturally occurred in private markets. But really the idea of free banking is just free banking. Free markets, there's no central bank, and people can choose whether or not they want to use the receipts of banks or they could use gold. There were two primary functioning systems of this. There's a total of like 60 that are qualified, but most of these systems were never truly free. You had government intervention that would screw up the incentives, and these systems didn't work well. A good example is like wildcat banking systems in the US. Those systems were an abortion. They didn't work well at all. New England had bond collateral laws that were screwing up the entire system. You couldn't even use gold as collateral in some of these areas. So that created a lot of boom and bust cycles. And there's a bad name that I think has been given to these, but like two systems that were relatively pure from government intervention, and they had a high degree of competition, were the Canadian and Scottish free banking systems of like the 17th to 18th century range. So I did a lot of research into those, and effectively how the systems worked is you had people that were depositing, scarce commodities that functioned well as money into local banks, and then those banks were issuing receipts, and those banks naturally started trading their receipts between one another because it made you more competitive as a bank if you accepted the money of others. And that created this natural system of all these banks settling notes between one another. And what we realized is, it doesn't really make sense for me to settle up with you in full value and for you to settle up with me in full value. Why don't we just net payments? And the process of netting payments led to the emergence of clearinghouses, which were kind of central to these systems. And that's kind of how I see this system building out. We're following a very similar pattern of how the financial systems build, where you keep the trust at more of a localized level. Think like a community bank or a localized credit institution. And then you have clearinghouses that are providing like larger scale collateral settlement on the back end. And that's kind of how we can have an interaction between the Lightning Network and ecash. So I'll stop there. So here's the report. I got a QR code. I'm going to bring it up like 2 more times. I'll just hold it at the end. And but this is an example. So like here's another example. The report got picked up by like Coin Bureau, and it's like a 20-minute video, and it's really wrong. So if you watch that video, it's like totally wrong. But it's starting to spread into crypto, which is what I think is, I was having a conversation with Hunter earlier, like this stuff, ecash is going to proliferate in a really rapid way, I think, in the near term. So going back to this idea around, why would we want this kind of a system, and why would we want to have trust? So I kind of like broke down like the high level of how it looks, and there's this quote from Hal Finney where he states, how many people in here know who Hal Finney is? Okay, cool. So he said in this Bitcoin talk post, there's very good reason for Bitcoin-backed banks to exist, issuing their own digital cash currency redeemable for Bitcoins, Bitcoin itself cannot scale to have every single financial transaction in the world be broadcast to everyone and included in the blockchain. There needs to be a secondary level of payment systems, which is lighter weight and more efficient. Likewise, the time needed for Bitcoin transactions to finalize will be impractical for medium to large value purchases. Bitcoin banks are going to solve these problems. They can work like banks before the nationalization of currency. I can read it from here. Different banks can have different policies, some aggressive, some conservative. Some would be fractional reserve, and others may be 100% Bitcoin backed. Interest rates may vary. Cash from some banks may trade at a discount to that from others. So that's like the most succinct way that you can really put this point. He did it in this like casual post, and it's a great way of saying it, to allow the free market competition of trust to fully enact. What I think Hal didn't anticipate is that the innovation wasn't done yet with Bitcoin, and that the banks themselves are now being innovated by using cryptography in other layers on top of Bitcoin. And I think that's what we're seeing with ecash. That's what we're seeing with the Lightning Network. We're not creating new tokens, but we're using cryptography in these novel ways. So I think the question with a lot of this boils down to, well, why should we trust? Bitcoin's this trustless object, not your keys, not your coins. There's efficiency trade-offs with it. One thing that I like to discuss that I don't think gets enough discussion online is that, so we have this thing in economics called the agency problem. Who here is familiar with this? Okay. Cool. So one of the things that, so it's argued that one of the primary ways that humans were able to genetically eclipse other species is by our ability to organize at large scale with one another. And a lot of that emerged from our ability to trust one another and for us to detect cheats within organizations, as well as for the creation of money, which doesn't require trust. And agency is something where it allowed us, by organizing, we could have people specialize and act as agents on our behalf in different functions. People were specializing, and because people were specializing, we create greater economic wealth. So by creating larger scale societies with more specialization, that created more trust, more agency between different people. Sometimes money is a part of that interaction, sometimes it's not. It depends. The problem with agency and the problem with trust is that it can lead to moral hazard sometimes. When you have a conflict of interest, and this is how it's like technically defined, if you have a conflict of interest between a principal and an agent, then that agent is going to take advantage of you, and eventually that's going to hurt you in some form. It's going to be moral hazard. So one of the ideas that I define in my book is that money, or the history of money, is littered with all of these instances of moral hazard, whether it's central banking, whether it's fraud. And financial services are one of the most regulated industries in the world because of that, for other reasons as well. And the idea is that because money is the most saleable good, it's the most desirable thing. If somebody were to ask you what good you want the most of, if you were allowed to have it infinitely, you'd want money because you can trade it for anything else. Everything else has a much higher diminishing rate of marginal utility for you over time. So money is the most saleable good, and it's more subject to the agency problem than any other good. And that's why financial history has been so littered with people wanting to control it. So Bitcoin solved this at a base level. And there's two ways that Bitcoin solved this. At a technological level, or I guess two framings that it solved it from. At a technological level, we can think about how Satoshi said in the white paper, we define an electronic coin as a chain of digital signatures. So like we created this technological innovation of being able to issue money in a digital format. He also solved this problem through incentive alignment. When we discuss the Bitcoin network and we defend it, a lot of its security is based on the fact that we trust the incentives. We trust how incentives were aligned. And that was kind of the primary innovation. There was a lot of technological advancement that occurred over the 40-year period of the cypherpunks and like the pursuit of an online digital cash. And one of the missing pieces was proof of work and the difficulty adjustment that Satoshi introduced. And that was like this missing piece that aligned the incentives in a way that has led us to where we all are today. And we really didn't know that until Bitcoin started to succeed. It's only something that could work out in the wild. And a good example from the white paper is, when we were talking about how under the concept of a 51% of the attack of the network, it's like, well, what really defends us from this? The miners could all attempt to have a 51% attack. And the argument is, well, anybody who would want to attack the network, he ought to find it more profitable to play by the rules, such rules that favor him with more new coins than everyone else combined, than to undermine the system and the validity of his own wealth. So that was an innovation, right? To have this incentive alignment that allowed the network to function. And much of the beauty and elegance of Bitcoin is kind of within this incentive alignment. So one of the problems is that Bitcoin didn't really solve the agency problem for everything. Bitcoin's like a base layer of the financial system, and the agency problem still exists within other functions. So I think the goal is that let's presume that Bitcoin just becomes digital gold and it exists within like the current financial system. We're going to create a system that's very similar to how prior systems worked, where political capture over that system eventually becomes an inevitability. And then that undermines the validity of the system towards the benefit of, you know, a fiat-based system over time. So I think that with a lot of these technologies like ecash or like the Lightning Network, we're not eliminating agency. And a lot of the technical discussion is kind of built around the idea of finding these perfect systems to where we don't have to have any sort of trust. And I think what we're realizing is that there's fundamental economic costs that are associated with that. We can remove trust. We've done that with Bitcoin, and we know that it's very expensive to do that in some forms. So the question is from my perspective, is how do we optimize that trust, and how do we optimize it for different functions? Agency isn't a bad thing. Going back to the idea of specialization, agency creates economic wealth. We want to have it in functions where it's necessary, but the incentives need to be aligned for it to serve its purpose. And we don't want to just think like, can this be done without any agency? But I think we want to be thinking, will this be demanded without agency? Because we can create things today, like creating wallets in the Lightning Network. And the question is, how many people are actually going to end up using these things that are very complex and hard to learn when we have high friction around them? So that's kind of one of the, this is like some of the thematic ideas out of it, is that cryptography is kind of optimizing agency. It did it in Bitcoin, and I think that it's continuing to occur in other protocols that interact with it. And so by applying cryptographic solutions to fundamental financial functions, we can reduce agency. And agency optimization is, I think, going to change the way that we organize, because we can, so one of the key ideas is that if we think about how our current system functions, well, okay, so let's start with Bitcoin. Bitcoin lowered the marginal cost of verification to zero within its network, or very close to zero. And that's what allows the system to be verified simultaneously by nodes all around the world at all these different points in time. And that's really cool, right? Multi-signature transactions is something else that I think is really interesting, because it's pushing the cost of shared ownership to very close to zero. There's going to be a future where we are going to create very abstract forms of multi-sig custody over assets that can be adjusted and changed at points in time. If you were to think about how we do that in the current financial system, shared ownership of assets is a very complex, analog type process, and that's very expensive. So we're also changing that by using something like a multi-signature technology, and that's just cryptography and software automation. There's no blockchain involved in terms of like these fundamental primitives. It's really just cryptography and software automation. So a lot of that goes back to like, this like network state type idea. Maybe these things happen, maybe they don't. I don't think we really have an idea of how that's going to happen, but it's going to make it much more easier and much more accessible for people. I think one of the other really big ideas that's emerging is that we have digitally native means of payment. So when I was first learning about Lightning, when I was first learning about ecash, I was like, okay, so we have Bitcoin, Bitcoin's money, Bitcoin's a specific monetary medium. Is Lightning the same thing as Bitcoin? Who thinks Lightning is the same thing as Bitcoin? Yeah, it's kind of like, well, basically, and yeah, it's kind of true, like basically, but it has different risks associated with it, right? Like if you want to participate, you have to be in a hot wallet. That's not the same thing as cold storage Bitcoin. So it's a limited functionality. You're limited by channel capacity. Bitcoin doesn't have that. Now the question is, do we consider Lightning Network payments a separate monetary medium from Bitcoin because it's different? Or do we call it something else? And I think that the analog is very similar to our current system where dollars are the monetary medium, but we have different means of payment. We have wire transfers, we have cash, we have ACH payments, and we have all these different means of payment. And I view that at a protocol level, we have something similar. And some of those means of payment are going to be more valuable than others. An on-chain Bitcoin transaction is going to be much more valuable to people than perhaps ecash settlement. In the same way that not everybody's going to accept a check. So that's kind of how I view when we have the Lightning Network and when we have ecash. It's like we're building out this, and I want to be careful with the word layered financial system because I think it's somewhat wrong, but it is a good analogy that we're building out like a layered financial system where in our current system we have the SWIFT network, and then on top of that we have the ACH banking payment system. And then we have credit-based systems and applications and all these other functions that are interacting with consumers on top. Right now we're still building out this basic infrastructure. And that's creating these different means of payment. But what I think is really interesting is what's novel is because these means of payment are interacting in like a peer-to-peer way, we are creating these digitally native money markets. And Nick Bhatia was the first to kind of propose the idea that earning routing fees on Lightning is this like digitally native risk-free rate that's starting to emerge within the system. And but there's a lot of other ways that people can effectively take their Bitcoin, use it in a digitally native manner by putting into protocols and earn an effective economic yield. That's all downstream from how many people are using Lightning for payments, how many people are using ecash for payments, and that'll determine how valuable that is over time. Today, it's not as valuable. Tomorrow, I think it could be significantly more valuable. So because we have these digitally native capital markets, it's going to allow people to participate in them directly in a peer-to-peer way, which doesn't really exist today. And that's a really cool idea because I think it's going to create a virtuous cycle of adoption where you can take your Bitcoin, you can put it into the Lightning Network, and you can earn routing fees by providing liquidity on behalf of people, or you can act as like an ecash market maker. The reality is that a lot of this is going to be done by service providers. And just like a Lightning service provider exists today, I think that the term Lightning service provider is going to continue to expand into other protocols, and they're just going to be effectively like Bitcoin or financial service providers. So that's really cool. And here's the link again. I'll pull it up one more time at the end. I was just shilling this thing in El Salvador. So I think the question is like, how risky is the system going to be? And there's just with anything, there's idiosyncratic risk. You can have cold storage Bitcoin on yourself and you can lose it. There's a lot of technological risks that can occur. That's solved with education and service providers that can, share some of that burden with you. I think the key question, and this is what I dig a lot into, is like the systemic risk of this system. Because I don't think we're ever going to be fully able to get rid of trust until we get to some sort of technological singularity or something. But until that point, we're always going to have trusted systems. I think the entire point and the problem that we're trying to solve is that we want to remove the systemic risk from centralized control over the financial system. So when we talk about decentralization within the network, it's like, okay, well, what is a node, right? If I run a computer and Tatum runs a computer, we can, we think about that as a self-custodial type node. But what about organizations that run a computer? That are all acting in unison based on a shared set of incentives? Are they also just their own single node? Or, what does that look like? And I think the entire point is that we want to build a system that is decentralized enough at the economic actor level And I think that's what's most important. And if we can push the marginal cost of things like verification and we can make automation strong enough within this system, it's going to become so efficient that there's never going to really be a strong means to over-centralize within the system. And that is something that's going to reduce the risk of political capture of the system. You know, the greatest atrocities in history, not just financially, but in any respect, have come from not just governments, but fundamentally centralized actors. And anybody who can create a large expanse of power over resources. And that is what's ultimately going to be deterred. And I think that if we can use this hyper-efficient cryptographic system, then we also are going to have something distinct where we have the peer-to-peer system as well. And you don't have to operate in any sort of trusted custodial system. It's going to be more expensive. It's going to require more education. And all of these things will exist. But never before, really in financial history, since primitive type systems, has it, in particularly in modern, in our the situation today, there's no way to opt out of our banking system. To function in the online economy until Bitcoin, there really wasn't a way to opt out. When we have a banking system that has to compete with a peer-to-peer system, that's always going to be this form of competition that's never existed within a system before. And I think that is also going to change the incentives over time as banks get larger, as they have more influence. If something goes wrong, every single time that happens, people are going to learn. And people are going to say, I don't want that to happen again. Maybe I just want to spend the rest of my life operating in a peer-to-peer system. It's going to be more costly, but that's what I want to do. So because that form of competition has never existed, I think that's going to change the incentives of the system significantly as well. So this is one of the coolest examples. So I've been kind of like rambling about all these abstract ideas, and it's just like, okay, well, what is something that makes an ecash trusted-based system? Well, one, multisigs can federate trust. But one of the cooler things is the founder of the Cashew protocol, Callie, he devised this like proof of liabilities type scheme, and effectively it's a way of automating bank runs. So that's going back to that point of the marginal cost of verification getting lowered to zero. Imagine trying to orchestrate a bank run today. Like, it's actually a lot cheaper. When we had all the bank failures in the beginning of 2023, people were blaming that on mobile money. People were saying, because consumers have apps, these things are happening more rapidly. And that's just because you have an app. So with cryptography, we can actually create these really interesting schemes. So the point of a federation, the point of using ecash is to maintain privacy for the individual. What would be really ideal is if the individual can retain their privacy, but at a systemic level, we can still audit how these banks are working. And that's a problem that everybody keeps trying to solve. Bitcoin's very auditable, but it's also pseudonymous. And that's something that can be very scary if you don't operate correctly. And as people attain more and more wealth, there's going to be a lot more attacks on people who aren't protecting their privacy. So if I were to participate in a mint and I send it to their multi-sig and I get issued back ecash, and I'm using some sort of wallet to do that, wallets effectively can use this type of a system where it would all be automated on their back end, and it would run this verification without you even knowing it. And if a mint was issuing burn and mint reports, so every time they mint ecash or every time people redeem it by sending or getting back their Bitcoin, it burns. And if they're issuing reports, wallets can be in a private format verifying whether or not they exist or do not exist within these reports. And I think what's cool is that this system wouldn't create a way to give any sort of guarantee that this would happen at any point in time, that you would catch a cheating mint that might try to issue more ecash than exists within the multisig. But it would make it probabilistically certain that if they do that, eventually they will get caught. And that's really what matters, is that little trick right there. That allows us to change the incentives of the system, where these banks always have to refresh their ecash. They have to produce reports every time they do it. And then every time they do it, they're going to get caught. And there's no marginal cost. I mean, if it was free for us to do that today with banks, it would probably exist. And it's going to be effectively free for us to do it in a system like this. So I think that changes the incentives of the system, where banks, people who are acting within these banks, they now have to say, okay, well, the only way we're going to be able to create like any sort of fractional reserve is if consumers are actually demanding it. It's going to be something where eventually we will get caught and it will get exposed. So the information transparency is going to be so much higher in this kind of a system, and it allows us to optimize for our trust. So this is kind of one of the primary things when people are debating like scaling online and some of these aspects. I think that one of the themes I want to get across is that we don't always need perfect technology, but we do always want to have aligned incentives within the systems that we're creating. And so this is Alexander Great cutting the Gordian knot. And the Gordian knot's representative of a highly complex problem. All these men are sitting around it, and they're just like, we can't figure out how to untie this knot. And Alexander comes up with a knife, and he cuts it. And that's what incentive alignment effectively does. Like, we can think through all these complex ideas, and we can try to use math to push it all away. And that's going to work in a lot of respects. But sometimes there's just a very efficient way, which is what Satoshi did with his incentive and alignment of the Bitcoin network, that actually solved all the problems without having to create any sort of like new technology. And that's really interesting. So I guess to round a lot of it out, it's not even like a thesis. It's still a bit of a curiosity, but I guess like the idea that I'm pushing is I think that the only way fractional reserve will exist in a trust-based system with the technology that we have today in the long term is if it's fundamentally demanded by society at a private level. And unless if it isn't, then I think it'll be too challenging to do it. Information transparency is going to be drastically increased in this type of a system. People are going to be able to unilaterally exit the system with a lot of different protocols. Transaction efficiency is going to be so much greater, and capital market efficiency is going to be greater because of all these things, and it's going to be a highly competitive system of the likes we've never really seen. And I think that that means that banks become service providers again, and it's not this conflict of interest that perpetuates from centralized control over time. And I think it's going to eliminate the risk of political capture. Because going back to the earlier point, peer-to-peer systems will be too efficient. They're always going to have to compete with that, and then even the custodial systems are going to be they're going to be pushed into these shared forms of architecture, and they're going to be highly information transparent and auditable. And hopefully, elected officials become public servants again once that happens. So this is like this big long-term vision, and I write into like the economic theory and the technical aspects of it, but it's like, okay, so where are we at today? Well, ecash is like this very new emerging idea, and we're watching it kind of explode in real time. This year, it's really started to take off. And in a good analogy, I think, is what we're really doing is we're kind of bridging right now towards these irreducibly complex systems. And while we're bridging, we're always going to need agency within the system to scaffold our way towards it. So right here, I have a mousetrap, and it has 4 components. And if you remove any one of those components, it ceases to be a mousetrap. And that's kind of how I think this hyper-efficient system I'm describing is it's going to take time, and it's going to grow awkwardly, and its feet are going to be much bigger than its hands. And then eventually, we're going to get to the point where we do reach this hyper-efficient, new, novel banking system where much of the agency has actually been extrapolated away with software and cryptography. And that's the Federal Reserve and the mousetrap. And then, whoopsh. So yeah, I think that's pretty much it. Did I have anything? Yeah, I got some links. I can share those later. Yeah, questions?
Cool. Thank you, Eric.
Yeah.